Hiring in the U.S. cooled for the month of June, with the economy adding 209,000 jobs. That's down from May. Still, wages rose and unemployment fell. Karina Mitchell dives into the data and tells us what it means for the Fed's next move.
Yeah, so absolutely. This was actually a fairly nuanced jobs report that we got. The Labor Department said 209,000 jobs were added in the month of June, below estimates. It's also well below the 306,000 jobs that were added in May. It was the softest month for job creation since December of 2022. Having said that, the number was actually fairly robust. Anything above 200,000 is considered to be strong. But that's not the number that the Fed is actually going to be focused on in this report. Instead, they're more interested in the inflationary component. So they're looking at unemployment, which actually went down to 3.6% from 3.7%. And they're looking at average hourly wages, which went up 0.4% month over month and 4.4% year over year. So this is the exact opposite of what the Fed was looking for in this jobs report. So what do they do from here? Well, it's most likely that when they meet in July, they will hike again once more. But then they don't have another meeting until September, so they have a little bit of time to think things over and decide the best course of action. Now, one piece of data that we'll get next week is inflation. CPI will come out. That's expected to come in at about 3%, the low 3%. And so does the Fed then say that this low 3% number is something they can work with if it's sustained and continuous? Do they then say that we will back off hiking rates or we'll pause for a longer amount of time? Or do they stick with their 2% inflationary target? If they do that, they'll have to slash labor, they'll have to slash wages, and that could lead to a recession. A lot of people could get hurt. Now, one thing that the Fed has done is they've let the economy run hotter for a longer amount of time to help people who have been marginalized. And even though it's a resilient labor market at the moment, it's those most vulnerable people that are hurting the most. So minority unemployment actually edged higher. Black unemployment this month climbed to 6%, Hispanic and Asian unemployment also higher, whereas white unemployment numbers dropped to 3.1%. Women are faring worse than men, and I actually spoke to one gender economist. Here's what she had to say about this jobs report and the people who are the most impacted.
Real concern right now is actually Black women. There was a lot of softening in the numbers for Black women in this particular report. So we saw, for instance, 165,000 Black women leave the labor force since last month. And that should be, and they also lost jobs. So that's a real concern for us. And it's not only an issue of fairness, it's actually an issue of economic growth.
So Roy told me that Black women are the breadwinners in 52% of households. So if they're laid off or if they're sitting out of the job market, that is not just bad for them, it's also bad for the broader economy, and it is also bad for the next generation. The Fed has worked so hard to help these marginalized people that is a factor that they will have to consider as they pave the way forward and decide what they're going to do with future hikes. Karina Mitchell, CGTN, New York.
And of course, the markets care very much about those jobs report. John Terrett has this from the NYSE.
What a week on Wall Street it was. Of course, it was a staggered week because we weren't here on Tuesday because of the July the 4th Independence Day celebrations. On Wednesday, we got the Federal Reserve minutes of the last meeting, the one in June, which suggested that there will be more rate hikes coming in 2023, but at a slower pace. On Thursday, we got the very strong private jobs report from the company known as ADP. And then on Friday, signs of cooling in the labor market in the official government report for the month of June. 209,000 jobs added, not the 230 to 240 that economists had expected. What does this mean? Well, the markets were all over the place on Friday. They were down on the initial publication of the news, then strongly in the green, and they finally finished the Friday session at the day's lows, or very close to the day's lows. But 92% of people on Wall Street think there will be a rate hike when the Federal Reserve next meets to make that decision on July the 26th. So on Friday, the Dow was down by 0.5%, 187 points. It's 3 days negative now. The Nasdaq down 1/13 of 1%, 18 points, with Apple and Microsoft lagging a bit this week. The S&P 500 down by 1/3 of 1%, 12 points, but on Friday with 5 out of 11 sectors in the green. On the cryptocurrency front, Bitcoin was down by 0.25%, Ether by 1.2%, but XRP was up 0.8%. And in the week to come, on Monday, President Biden goes to Windsor Castle, just to the west of London, to meet with King Charles III. On Tuesday, Amazon Prime Day gets underway. Of course, it's a two-day event. Wednesday, CPI, another key bit of data for the Federal Reserve to digest. And then earnings season gets underway for the second quarter. We hear from Delta and PepsiCo on Thursday, and then it's the turn of the big banks, Citi, JP Morgan and Wells Fargo and BlackRock next Friday. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
To help us make sense of the economy, Anthony Chan, former chief economist, JP Morgan Chase, back with us. Good to see you again, my friend. On Wednesday, as John said, the Fed released its notes saying they're going to hike rates. We already knew that. On Thursday, the jobs numbers were hot. The markets didn't like that either. Then on Friday, today, the jobs were a little light. The markets didn't like that. The market doesn't like anything. What's going on?
Well, I think that different sources of that data will give you different outcomes. We know that the ADP report is just a subset of the entire labor market, and even the employment report is a subset of actual labor. So we really have to look at all those pieces together to come to some sort of a conclusion. The conclusion, I think, is pretty clear to me, and that is that the labor market is softening a little bit. You saw that certainly from the JOLTS data that showed that now we have 1.6 jobs for every person that's unemployed, and that's down from 1.8 in the prior month. And then, of course, this latest number showing you that things are easing a little bit. But Phil, if you really want to zero in on what's really going on, look at the number of people that were working part-time because of economic reasons. In other words, because of economic conditions. We have almost 500,000 people in that category. That number is pretty high, and that suggests things are slowing down a little bit. Maybe not enough to slow down wages as quickly as the Fed would like, but they are slowing down.
If I told you a little over a year ago that we would hike rates 5%, which is kind of where we're at now, and rates are where they are at today in terms of short-term Treasury yields, and I would say, well, the job market's still strong. We're still adding jobs. The unemployment rate's still at an all-time low, albeit there are some quirks to that. And in addition, oh, by the way, the housing market is still near the all-time high. I mean, you have to be a little bit surprised by this.
Well, yes, you have to be a little bit surprised, but not if you look at everything that's going on. Remember, Phil, we got $10 trillion worth of stimulus. A lot of people like to compare this to the global financial crisis, or maybe even compare it to other periods in history when you had a slowdown in economic activity. We never got this much stimulus right after that. And by the way, it wasn't even just the stimulus during the period of the pandemic. We got another batch of stimulus. Now we're starting on another batch. We're going to have the CHIPS Act. We're going to have the Infrastructure Act. All those things are sort of ongoing. And by the way, we haven't taken back all the monetary stimulus that was injected into the system. So all that makes this a little bit different when you're comparing one cycle to the other.
What does the Anthony Chan Act say that the Fed should do next? Because they're looking at this, thinking to themselves, we're trying to slow it all down. Gosh, it's taken a while. Inflation, albeit, has crept back a little bit lower, but I think that the market is still very concerned that it might rear its head up again.
Phil, I think you're spot on. The Federal Reserve has made quite a bit of an accomplishment here. We had the CPI at 9.1%. When we get it next week, it's probably going to have a 3% handle. That's almost 600 basis points decline. The problem is that they like to look at core inflation, and the other problem is that the actual target is about 2%. So they would like to get it there a lot sooner. So when they talk about having to hike more and even hiking, part of it is bluster, and part of it is to protect the inflation-fighting credibility of the Fed. Because remember, they probably started hiking rates a little late, and so they have to catch up.
So look, you and I talk in a lot of economic terms, and I think for the majority of people out there, they just care they're getting a paycheck, food's on the table, life is generally good, they're watching sports. My question is this: why is this such a big deal? Why can't we just have things the way they are? So inflation's running at 3 or 4% big deal. Unemployment is low. People are working. Generally, the quality of life is significantly better today than it was during COVID. I mean, there's much to be happy about. What's wrong with the way things are right now? Why do we have to monkey with it?
Well, I think that they have to, or they feel they have to go to 2%. But I don't disagree with you, Phil. I think they don't have to rush it. I think the fact that there's still a lot of monetary tightening in the system and working itself through means we will get to that 2%. They don't have to rush it. And for that reason, I think they really don't even have to raise rates in July. Clearly they are, because they told you they're going to do it. The market's expecting it, and the Fed never likes to disappoint the market. But if they do one more hike, yes, it may take a little bit longer to get it to 2%, but if they go at it too quickly and too aggressively, they're going to end up taking the economy into a recession.
But again, to my point, what's the difference? You've hiked so many darn times. What's another 25 or less 25? Is that really going to change how we view the world or how consumers react in the U.S.? We're not going to stop buying cars or stop buying homes because of 25 basis points.
Well, remember, Phil, they're trying to maintain that credibility that they're serious about inflation. You notice when you ask Powell, can you change that inflation target to 3%? He almost gets an aneurysm when he hears that. Now, behind the scenes, he was probably thinking, I don't need to rush, but he can't say that, and he has to act as though he's really serious about it to make sure that the markets don't start to build in a 3% inflation. They want to gradually move there, maybe a little quicker, and they will, but there's no need to rush. I don't disagree with you.
We shall see. Anthony Chan, always good to see you, my friend. Have a good weekend, sir.
Good to see you too, Phil.